Hi, everyone. Thank you so much for joining us today. My group and I are going to be talking about Goldman Sachs and their history, as well as our Owanda trading. This is kind of a little overview of where the presentation is going to go, and I'm going to kick it off with the inception of Goldman Sachs. All right. So in 1869, Goldman moved from Philadelphia with his wife and 5 children to New York City for a greater financial opportunity. Originally, he emigrated from Germany actually to Philadelphia. So he opened a small shop on Pine Street called Goldman Sachs & Co., and he was buying and selling promissory notes. He observed that the bank credits at the time were expensive and therefore found his position in helping small businesses attain short-term capitals. He would then sell these loans to larger institutional leaders and keep a small profit for himself. His clients were often jewelers, leather merchants, or tanners on Beekman Street. By the first year, he had already traded $5 million in commercial paper. He was growing his reputation, and his network with financial leaders allowed his business to flourish. In 1882, his son-in-law Samuel Sachs joined the firm as they started expanding into other business developments. And by 1885, his son Henry Goldman and his other son-in-law Ludwig Dreyfus also joined the team. In 1890, they were already turning around $30 million and even started trading in the New York Stock Exchange. At this point in time, the company had expanded to 5 partners with the additional help of servicers and clerk. So their company was really growing. They were able to expand into San Francisco, Boston, and St. Louis, making them a national firm. In 1906, the group had started acquiring larger accounts, such as Sears, and began competing against larger institutional banks. They were able to bring in a capital of $40 million, $10 million in preferred stock, and $30 million in common stock. However, this reward didn't come with no risk. The success did not come lightly. He was originally of Jewish background, and Wall Street major bankers such as J.P. Morgan were shutting him out of their businesses, specifically in the railroad and industrial sectors. He was able to gain traction by pioneering into new markets, which, however, came at a great risk. But he wasn't really given much choice. Efforts in trading for non-railroad companies began to revolutionize the economy and open up new industries. After the Sears deals was a success, they started underwriting other major retail players such as Studebaker Co., an American car company, the May department stores, Stern Brothers, and others. Their underwriting strategy focused more on capital valuation and future growth rather than current assets, which gave investors a completely new perspective of underwriting. The idea became the dominant asset tool used today, which is the price per earnings ratio. Marcus Goldman had a pivotal role in changing the way the American financiers valued companies and priced capital, and that he was forced to think out of the box, leading him to great success and financial power. By 1907, the economy had been going through a recession, and the bank runs had been a common occurrence, forcing many companies to go bankrupt. Waddell Catchings joined the Goldman Sachs as a partner in 1918. He had a lot of success in the past of restructuring many bankrupt companies and led the Goldman Sachs Trading Corporation Trust. Initially, stocks were trading at about $104. This became the largest investment trust yet. 42,000 shareholders, $50 million in capital, $50 million in cash surplus. They were able to merge with financial and industrial sector security corporations. There was great excitement and support from its shareholders, doubling their stock value. This momentum meant that they could acquire other trust companies in San Francisco and Shenandoah Corporation and the Blue Ridge Corporation. Not just Goldman was soaring, but also the economy. The financial optimism had allowed people to put 10% down on their purchases, with trust not collecting any collateral other than the stock itself. It had allowed ordinary people to purchase equity in corporations by borrowing funds. These highs created an unsustainable market, though. When the stock market started to fall in 1929, it fell hard, with no collateral available to protect its losses. Goldman Sachs Trading Corporation had acquired so many trusts, it bared the full burden of the crash. By 1930s, the trust value had dropped to $40.94 and lost 50% of its market capitalization. 2 years later, the stock was valued at $1.75. It led to Catchings leaving Goldman Sachs and Walter Sachs to liquidate the trust assets. They were really only able to attain one account. Sidney J. Weinberg was appointed to the leadership position of Goldman Sachs and was the first non-family member to hold this role. He was seen as an icon of the American dream as he moved up the ladder from being a janitor to being known as Mr. Wall Street. He guided Goldman Sachs through the lawsuits against the trust and rebuilt their reputation. They refocused their business on their most impressive talents, which is underwriting and equity in sales and trading. In 1950, Goldman Sachs was back to growing its empire. In order to maintain and grow their customer service base, they needed to employ over 500 new employees. It began growing from within, establishing a merger acquisitions department, trading and hedging department, and reorganized the equities division, created a municipal finance sector and a real estate department. In 1970, they decided they needed to go national in order to offer their full service to their clients. Their first international office opened in London, and Zurich and Tokyo followed later. In 1972, the fixed income department gave Goldman Sachs momentum in government and corporate debt market trading, and they really refocused on innovation, offering options, swaps, and futures. In 1999, a historic vote was decided that Goldman Sachs, as a company, was going to go public. Their growing clientele base with this new influx of capital would allow Goldman Sachs to expand globally and provide the full services they were demanded of. It enabled them to access the center of the global finance market in Europe, America, and Asia. 2008 was the technology boom and pop. The real estate bubble created controversies in Goldman Sachs' role and reputation. Although many other investment banks took part, Goldman Sachs' scale and position within the investment industry leaves many to believe that they were major players in the crisis. It was concluded that the crash was due to inaccurate ratings of mortgage-backed securities from 2005 to 2007. Their position was seen as a conflict of interest as Goldman Sachs didn't hold any equity in the securities they were ensuring investors were well credited. Today, they would continue to rebuild their reputation and trust with their clientele and still stand as the second largest investment bank in the world.